It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Now, with the rotation into small caps well underway, we're taking a look at two energy producers, one that could struggle, the other way undervalued and poised to deliver, at least according to our guests. So let's get to it. I'm here with Lou Basenese, MDB Capital Holdings President and Chief Market Strategist. So these guys are both small caps within energy.
Yeah, small caps with an energy kicker, so obviously more speculative. I gotta make that disclaimer.
Okay, that is good to know. So let's get to the first one, which has one of the more adorable logos that I've ever seen, by the way, but we'll get to that in a minute. The stock is already up about 50% over the past 12 months or so. We're talking about Prairie Operating, and it's got a little prairie dog on the logo.
Yeah, I think it's a little irreverent and cute, but it's very serious business. They're committed to being cash flow positive and funding all their growth without debt, which is a rarity in the energy and
yes,
space.
most
so
definitely.
Unlike everything else there. So they've already been doing that with acquisitions. So there's undeniable demand here. We're going to need it domestically, whether we have a President Trump or a President Harris. So I think that bodes very well for Prairie's operation.
So that's sort of the underpinning here, is that you think the demand is going to be consistent here for domestically produced energy.
And it's because of things that we were talking about before, AI. Power consumption from data centers and AI is going to make domestic energy needs much higher this year and going into next year as well.
And these guys are in Colorado. I think that's an important distinction here because, you know, yes, mostly we will not see demand affected by whatever administration. You could see where pumping is allowed, potentially affected, or if there are more places that open up.
You're exactly right. Geography matters. Permitting already matters. So they've got a big portfolio of permits that are already approved, another one getting approved. So going into production, and you're taking some of that regulatory risk out of the equation.
Gotcha. You mentioned acquisitions. Talk me through that a little bit more.
So they have this unique strategy where they want to acquire assets that have been neglected but that are adjacent to the major producers. So Chevron, Oxy, EOG, and they're focusing largely in Colorado, the DJ Basin, and they've made multiple acquisitions, 2 new ones this year, that are just going to go right into production. So I think it's a smart, low-risk strategy. A lot of times people are buying exploration assets, right? They're not sure if there's proven reserves there. They're not sure if it's going to work out. Prairie's taking out that part of the equation, saying, let's just get into production, cash flow generation, and then keep growing conservatively with what the cash flows we spin off.
Gotcha. And talk to me a little bit more about that. Cash management, the fact that it doesn't have debt, which, as you mentioned, is unusual.
Yeah, I think here the cheapness is what's attractive, right? If you look at companies in the oil and gas space, they're trading for about 4 times EBITDA. Prairie's acquiring companies at 2 to 2.3 times, so they're arbitraging that private versus public market valuation, and then they're bringing them online. So I think it's a very conservative way for this stock to go from, you know, the current price around $10 to $20, spin off anywhere from $100 million to $250 million in EBITDA by the end of next year. So you put a multiple on that of 2 to 4 times, and you're at, you know, $500 million to $1 billion market cap. So
gotcha.
Very attractive for a small cap.
Well, let's talk about risk though, because you said it is speculative. I mean, we could see oil prices come down. That's one risk,
right? I mean, I usually deal with technology. The risk here in a commodity space is the commodity collapsing, right? If we enter a recession, I'm a contrarian. I don't think going back a year, I don't think we're anywhere near a recession. I still don't think we are, but that is a definite risk that could impact that.
I wanted to ask you as well. You mentioned they've got this goal of being cash flow positive. They still are posting net losses, though.
That's correct.
Is that a concern at all?
Not right now. I think as they start to bring production online, you'll see that it'll flip to the bottom line, and it'll turn into a traditional oil and gas play that pays a regular dividend. So
gotcha.
I think that's the future potential to be evaluated here.
Let's get to the other small cap play here, the one that you say to avoid. This is Gran Tierra Energy. These shares are also up over the past year, in this case, almost 40%. But you think these assets look more risky. Why?
Yeah, I mean, very simple. It's a Canadian-based company, but their operations are in Colombia and Ecuador, not 2 of the most friendly countries when we talk about investing internationally. If you have a global crisis, these are not the democracies that we know and love that are going to be conducive to investors. So risky assets for sure, unlike Prairie.
Gotcha. What about the balance sheet in this case?
We talk about this. Most oil and gas producers have a lot of debt on their balance sheet, and Gran Tierra, even as a small cap, has over $600 million in debt on the balance sheet. So that just sets up a risky proposition if the interest rate environment changes, if the funding environment changes, that they might not be able to continue operations.
Okay, and then finally, while the other one's cheap, you don't think this one is?
Yeah, if we look at the stock, I mean, the stock's up about 70% this year, and it's not been on profit growth. It's been on multiple expansions. So it's trading at about 110 times historical earnings and a forward P of 16 times, which is more than 4 or 5 times the historical average. So it's just gotten gotten ahead of itself. It was a great play this year, but I don't think it's going to continue to be a great play heading into the remainder of this year and into 2025.
The same risk as the other one, which is interesting. Although a risk in the other direction, that you see a spike in oil prices.
Yeah. So here, when supply becomes constrained because we have an uptick in the conflict in the Middle East or another conflict with Russia, it's going to make those reserves that they have in even risky nations more valuable. So
Gotcha.
If oil prices spike dramatically, you're going to see that probably Gran Tierra will still benefit some from that.
Okay. That sums it up as we look at these two small cap energy shares. Thanks for coming in, Lou.
Always a pleasure.
Appreciate it. Thanks so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.